I was really surprised at this. It was just yesterday we were talking about the dramatic increase in video views on Snapchat. They were catching up with Facebook, and now we found out Fidelity dropped their valuation by 25%.
But it's a liquidity issue. It's not necessarily a value of the company. People might like it, but when you need to go sell it, that's a different story.
There's a couple things going on. I mean, for years, billions of dollars have been pouring into these companies, as we've started to call them unicorns, special companies. The problem is that now we're starting to see these these funds like Fidelity that have to release data on their valuation of the companies. We're getting a glimpse now for the first time into how they value them, and they're starting to say, hey, wait a minute. These companies aren't quite worth as much as we thought they were. They have a business model, but there's way too much money chasing after too few really good ideas.
See, that's what struck me as interesting about this, because back in the late 90s, when there was the tech bubble, people went public. And so the markets were looking into the valuation all the time. A lot of these valuations are private money.
Right. And
you don't get a peek into them. But Fidelity, because they're public, you get a peek into it.
Right. I want you to just pull up. We have a screen right here. This is venture capital fundraising versus these tech valuations. Look, it's been a bit of a runaway train the last years. And you know, VC, it's these traditional money managers and insurance companies that have had investment envy and simply saying, I got to get myself out there to California, throwing money at these investments. And now when they suddenly need to mark their books, it's not so clean.
Exactly.
Right, and you don't have the day-to-day movements of the market like you do with a publicly traded company, where you can see day-to-day exactly how they're hurting, how they're benefiting.
So do we have any sense what Fidelity is seeing that we're not? Because as I say, we were talking about the dramatic increase in videos, and Facebook is making a lot of money off of videos. So obviously they're seeing something we're not seeing.
Facebook's doing very, very well. You're seeing a lot of other companies facing the same thing. Here's an example, Square. We just got their IPO prospectus. They raised money at a $6 billion valuation, but they're valuing themselves at $4.2 billion. Big drop off. Some people are saying, hey, they're just being conservative. There's a lot of room for growth here. They could come out in the next few weeks and say, actually, we're going to go to a higher end of the range, higher valuation. Still, there's a big delta, $2 billion.
And that's effectively a down round.
Right,
essentially.
absolutely.
And nobody ever wants to do a down round in this business.
No, and a lot of those people who are invested in the early rounds can't get out of their positions. There are people who are early investors in in Uber, who love to talk about the valuation now. Well, guess what? Even if Uber is valued at $50 billion, they can't sell out of their position if it was 40, 30, or 20. There just isn't the liquidity right now. But it looks really good on paper, and you sound very cool at a cocktail party if you say you're an early investor in Snapchat or Twitter or certainly Uber.